G'day there, ladies and gents. Mark Wallace here from Econisis. Hope you're all doing well today. It is the last week of June 2023. This video might go out in the beginning of July, so if that's the case, welcome to the new financial year. Today I want to talk a little bit about labour productivity, which is something that's in the news and in the media a lot, particularly with the RBA victim blaming workers as being lazy and not being productive enough and therefore not earning the wage rises that they're currently getting, which have been returning to a more long-term average after a extended period of suppressed wage growth under the previous government. Unfortunately, there's a lot of confusion, particularly with the RBA, as to what's happening with labour productivity, because they seem to misunderstand the interrelationship between labour and other factors of production, capital-related productivity, and what we call multi-factor productivity. So productivity is basically the measure of economic activity per worker. And the idea is that as that increases, workers should be afforded increased wages to be commensurate with their overall productivity. Now, at the moment, wages are growing faster than they were, faster than labour productivity. However, that current labour productivity has actually declined from a very high base as it was during the COVID period of time when labour productivity went through the roof. And so it really is just returned to more of a longer term trend, and is seeing labour productivity continue to be positive, although not as positive as wages growth. Now, looked in isolation and in taking a very sort of academic economic theory perspective, that suggests that wages are exceeding productivity and therefore are adding to inflation. And that's really the dogma that we're seeing emerging from the RBA at the moment. However, once again, they've completely misinterpreted what is happening here, because labour productivity cannot be viewed in isolation to other aspects of multi-factor productivity, in particular business investment or the lack thereof. Australia has always had a relatively low level of non-mining business investment compared to other countries, which has been the primary contributor to what has been a lower than average multi-factor productivity output or outcome in Australia compared to a lot of the other OECD countries. And part of that reason is because both our tax system and our business culture has generally been averse to capital investment. Instead, when you have new businesses or businesses that are being restructured, it's always approached to cutting costs rather than investing in new capital. When we have seen periods of significant labour productivity, it's always been in response to business investment. Labour productivity is an outcome of business investment in capital, and particularly business investment in information and communication technology, or ICT. Digital and ICT technologies have been a major driver of labour productivity because the businesses are giving the tools to the workers to be more productive. And so when you have a situation at the moment where workers really can't work anymore, there's no more extra hours to extract, there's no underemployment really in the network, in the system, labour market at the moment, then the only real labour productivity you can get is labour productivity that is a consequences of business investment. Now, this is where the really interesting relationship with tax comes in, because if you look around the world, business productivity and business investment in capital is highest amongst higher taxing economies. The more you tax an economy, the more innovative it becomes, which seems counterintuitive. But what it reflects is the fact that at the higher marginal tax rates or higher tax thresholds, there's a decision to make between investment and paying tax. And we see that both in research and development and also in business investment. And so the periods in the US where the business tax rates, corporate tax rates have been the highest, and the marginal personal tax rates have been the highest, is the periods where we've had the highest level of productivity in that country. And the same has been the case in Australia. So when we see countries like Australia or like the UK or the US looking to cut or reduce corporate tax rates, this actually has the opposite effect that is expected to happen, which is the businesses don't invest in capital and don't invest in productivity gaining equipment. What they do is they invest in financial instruments, or they just generate larger profits. Now, for some cases, that is the intention. It's basically a wealth shift from personal household sector to the business sector, and that's the intention. And particularly in the right side of politics, it's a purposeful, intentional object or intention to do so. In other countries where it's being done by other parts of the political spectrum or being promoted by more neutral think tanks, it's basically a misunderstanding of how the business dynamics work with the tax system when it comes to this productivity. Anyway, we're continuing to deal with what is effectively victim blaming on the part of the RBA, of workers, their misunderstanding, their very academic and increasingly de-skilled academic economic understanding of the theory of how economies work and how that differs to the reality of how economies work. And unfortunately, wages, and as it is always the case is in Australia, we like blaming people for their own misfortune. And unfortunately, in this instance, businesses are getting a free ride when it comes to their lack of investment in productivity, generating capital and equipment. But that's it for today. Thanks everybody for watching this one. Have a great one. Talk to you soon.